The hottest investment trend on Wall Street, SPACs are exploding. The rise of blank check companies on this edition of Business Talk with Jim Campbell. William Houlihan was an investment banker at Goldman Sachs, now serves as CFO for the Thunderbridge financial technology-focused special purpose acquisition company, part-time adjunct professor teaching strategy in the undergrad business school at Montclair State University, 44-year career in business, including as a chief financial officer for 9 companies, a member of the boards of director for 7 companies, accountant for Deloitte as well, where my daughter works. He has an MBA in finance from NYU, a BS in accounting from Manhattan College, graduated same year I did from college, 1977. He's the founder of the Houlihan Invitational Golf event, beats me at golf. And his son just had twins, and we have twins. So I love getting together. And how this originated was on the golf course. I was asked Bill what he's doing. He would explain what sounded to me like opaque, esoteric center of the capital markets that I didn't really fully understand. So all of a sudden, this thing blows up, the hottest thing on Wall Street. So I said, why don't we just talk about it on a show as well? And just to give some background, 2009 to 2019, it ranged from a low of, in the first year, 1 SPAC for $36 million raised to 59 and 13.6 billion. Last year, for some reason, 2020, 248 IPOs raised 83 billion, and 2021 is on track to blow by that. NASDAQ and NYSE are fighting to get these listed on their respective changes. Blank check IPO, Bill, what is a SPAC?
Okay, well, SPAC, the acronym, as you mentioned previously, is Special Purpose Acquisition Corp. So it is a pool of money, publicly traded, with the intention of making one large acquisition. So it is similar in respect to venture capital funds or similar to private equity, but it is not a fund. Those funds are private partnerships. They're not publicly traded. They negotiate with their investors what they're allowed to do, but generally they're allowed to make multiple investments over a multiple period of time. The idea for SPACs coming through the SEC, but also promoted by private industry to the SEC, which the SEC then endorsed, was to create a publicly traded vehicle for institutions and for individuals who couldn't easily get into the private vehicles that have a much larger public, much larger minimum investment. And to create investor protection, number one was the SPACs could only do a single large deal. They couldn't do a series of investments. They also can't buy just individual stocks and bonds. It's not intended to be an investment company, actual or disguised. It has to be an acquisition vehicle. The additional investor protection is that the SPAC has a maximum of 2 years to get its large deal done. If it doesn't, it's required legally to dissolve itself and give all the money raised in the IPO back to the investors. So investors are taking acquisition risk, but they are protected in a couple of ways by it's a single large acquisition, and it has to be done within a discrete period of time and the money given back to investors. There's another very important investor protection in that 100% of the proceeds raised in a SPAC IPO are invested in a trust for the benefit of the IPO investors. None of the money raised in the IPO can be used by the management of the SPAC to pay underwriting expenses or legal expenses or other deal expenses. And none of the money raised in the IPO can be used to pay for the operating expense of the SPAC while it's looking for its acquisition. So part of the reason the market has taken off is this is actually a well-protected investment for the retail investor or the institutional investor. The market has actually become much more institutional in recent years as the market has grown. And from the investor's standpoint, what they have is a cash protected investment in a trust that may turn out to be a valuable equity investment if the SPAC sponsor finds an acquisition and closes on the acquisition.
I did not realize there was one company per SPAC. How does it differ from the reverse mergers into shell companies, which sometimes is a good place to hide a bad company?
Sure. Well, number one, SPACs as a legal entity have existed for many years, you've said. So has the idea of a public company, which really kind of went nowhere. Now it's public, but it doesn't have a business. A private company merges with the public company. So in the reverse merger, as you suggested, what happens is legally it's a similar structure. There is a publicly traded vehicle, a private company merges into the public vehicle, but there is very little known about the public company, and there's very little known about the private company. So the resulting company becomes public, but it takes quite a while usually for the market to figure out what's in that company. SPACs, because the transaction is done through a public offering, get more visibility and have sponsorship of major underwriters. For many years, Cantor Fitzgerald, a boutique firm, was dominating the SPAC market. But as the market has dramatically increased in size, as you mentioned, Jim, it is now every major Wall Street firm now is involved in SPAC underwritings, and investors who are interested in SPACs can see multiple offerings. There's hundreds of publicly traded SPACs through CS, Goldman Sachs, JP Morgan, or any major firm or boutique firm, regional firm that is out there.
And SPAC costs, underwriting costs, deal costs are cheaper than IPOs. Is that right?
They are. They're bifurcated also into two tranches. But the initial cost for a SPAC legally can be whatever the SPAC sponsors and the underwriters agree to. But kind of the industry convention has been 2% of the proceeds from the IPO is what is paid to the underwriters at the closing. So that is much lower than the usual 7% fee for an IPO. There is a second leg to that, though. The other industry convention is that an additional 3.5% of the IPO proceeds are payable to the IPO underwriters when the SPAC sponsor completes an acquisition. The reason for the breakage in the fees, or the bifurcation in the fees, better way to say it, is the first sale, selling cash, if you will, in a trust, shouldn't be all that hard. So the investment bankers get something for that, but less than the full fee they get for selling an operating company IPO.
You said,
but excuse me, but then just finish the segment. But if the sponsor can successfully find an acquisition, then it has successfully deployed the cash. That's a good reason to pay the investment bankers, a significantly higher additional fee.
You were talking before about deal expenses, and the operating expenses of the SPAC while they're looking cannot come from the trust deposited by the investors. Where is that money coming from? Is that money that you guys have to put in as a sponsor? Or?
Yes, it's raised in a private offering. So the typical private offering is about 3% of the proceeds raised in the IPO. The 3% covers the 3% goes to pay for the investment banker fee, the initial investment banker fee. Part of it then goes to pay for the legal, accounting, and other costs for doing the SEC registration. So, which is not de minimis. It's not an operating company. It's a shell company. But the typical IPO prospectus is 100 pages or more because it's full of required legal disclosure about who the SPAC sponsors are and the risk factors involved in this kind of offering and things like that. The sponsor also then wants to make sure when it closes the deal, it still has $1 million or so, as usual, kind of the number most people shoot to have on hand to handle the quarterly accounting and SEC costs, plus have a pool of money available for due diligence expenses as it looks for acquisitions.
All right, we're down to the last minute of this segment. Obviously, the good is this is now accepted in the market. It's huge. Is the bad? Is there now going to be too much money chasing after deals, which we know causes inflation of acquisition prices?
Almost certainly. And I've been a CFO of two companies that have uh, completed IPOs, and one has completed an acquisition, other has announced an acquisition. We have a third deal that we just closed our IPO last week. But there's no question that the targets haven't increased, but the amount of money raised seeking targets has gone up. So that certainly suggests there's more competition for targets, and prices are going up for sure. And that may mean that some deals that get done maybe shouldn't get done.
All right, listen to Business Talk with Jim Campbell. You can go to our YouTube station, jimcampbellradio.com. We'll go inside SPACs in the second segment with Bill.
Hi, I'm Robert Reese, and if you'd like to learn from the top CEOs in America, join me weekday afternoons at 5 p.m. for the Best of the CEO Forum on 1540 AM WADK, Newport, Rhode Island.
We're back, segment 2. Former investment banker Bill Houlihan taking us through what SPACs are. And I want to talk now about the structure of SPACs, because they're not necessarily that straightforward. Units, redemption rights, warrants. Bill, can you take us through how they're structured and what those components mean?
Sure. The typical SPAC offering that exists by market convention. There's no legal requirement that the SEC has that it can only be shares, or it's required to be shares plus warrants or something else. But the market convention that exists now is the IPO is not of shares alone. It is of units. The units consist of shares plus a certain amount of warrants. So the market convention of shares plus warrants is intended to give investors what a warrant does, give them an extra kick, more than just the shares in the company. So the reason for that is, as we talked about before, for many years, SPACs were a very, very small, limited market, and to get investors interested in the product, the promoters were giving people an additional reason to invest, a warrant. The shares, since you're selling cash effectively in a trust, the shares are always priced by market convention at $10 a share. Cash is cash. They could be at $1, they could be at $100. The market convention is they're priced at $10 a share. The warrants, the market convention, and they could be anything, but the market convention is the warrants have an exercise price of $11.50 a share, so a premium to where the IPO is sold, but they have a 5-year term. So if the SPAC sponsor finds an acquisition and it can successfully close on it, the investors can benefit over time from how the shares may perform, as well as how the warrants may perform. The warrants are not unlimited in term, so the usual term is 5 years. And in addition, if a deal does very, very well, the SPAC is allowed to redeem the warrants at a price of $18 a share. So the warrant doesn't give the investor unlimited upside the way the share does, but it gives them an additional kick. It's not a free ride, if you think about it, because since you're selling warrants, you're putting out additional equity ownership into the market. That equity ownership has a dilution cost to it. So while you're giving investors a way to potentially benefit, it's a theoretical benefit if the company does well, but if the company just is a mediocre performer or a poor performer, there's no guarantee that the shares will do well or the warrants will do well. In recent times, though, part of the reason the growth in the market is many deals have done well. Sponsors have found deals that the market has thought these are attractive growth opportunities, and the shares have done well. The warrants have done well. Just by way of an example, the first company that the Thunderbridge SPACs that I'm the CFO for did, we did an IPO in June of 18. We raised $258 million in July of 19. We closed on an acquisition of a company called Repay Holdings, which was an electronic payments business. It was a niche business, working much smaller parts of the market than PayPal or Square or other people like that. But the market found an attractive deal, and in the year and a half since that deal closed, the stock went from 10 to 26, and the warrants were redeemed. The warrants were five-year warrants, but the warrants were redeemed inside of a year at that $18 a share exercise price. So investors there got 160% return on their money plus a warrant kicker. That's obviously very, very unusual kind of return, unusually good. But that's what, when people see SPAC opportunities, are like, holy cow, that's the kind of early stage growth company I would like to be able to invest in, but I usually don't get a chance to invest in because the private equity funds, the VC funds make the investment before I can do it. And even when it goes public, a lot of brokerage firms don't allow the average investor to buy IPO stock. The only time you can get it is after the IPO has been publicly distributed and a lot of the appreciation has been already made.
Is where do these SPACs trade? NASDAQ and NYSE based on some formula, and where do the warrants trade?
Sure.
How do they?
Yeah. Any whatever the deal is done, the shares and warrants trade on the same exchange. Can be NASDAQ. It can be New York Stock Exchange. There's a lot more deals being done on NASDAQ because many of the underlying targets are tech oriented. It's not, obviously you can be a tech stock on the New York Stock Exchange or NASDAQ, but by market convention, NASDAQ has focused on a lot of growth opportunities, and many SPAC sponsors go to NASDAQ to signal their intention of trying to pursue tech transactions.
So they're $10 a unit. First of all, can they trade below $10 since it's really cash? The answer would probably be no, but once it's in the market, it could go down the tubes.
Indeed, that's a good observation. The common stock should never trade below 10 because it's in a cash protected trust. Actually, in March of last year, when the COVID fear was in the market, there were numerous SPACs that traded below 10. It was no logical reason for that to happen, but it did, and so there was actually some easy money to be made for people who were, looking for different alternatives to buy it. Then, one other feature of the market, Jim, I should mention, is while the deals are sold as a package of units, shortly after the deals close, the market convention is also that the stock can trade separately, the warrants can trade separately, or the units can continue to trade as units. That's just a way to broaden the market for what let different people pick.
So you can buy the package that includes the warrants and the stock and keep them together?
You can.
People don't, though, is what you're saying.
Well, no. Well, people do different things. That's why the market exists. Many people, it's a common trade to buy the units, hold on to the warrants to have the extra upside, and then sell out of the stock, because until an acquisition gets announced, the stock's only going to be worth 10. It's it's safe money, but it's kind of dead money. So if you're trying to, like last year, the average stock was up. Conventional stocks were up more than 10%. Tech stocks were up more than 40%, even with all the COVID fear in the market. So if you bought a SPAC unit and held on to the warrant, you could sell out of the stock and buy a new SPAC to get more warrants, or buy anything else in the market to give yourself more upside if you wanted to play it that way. Not everybody does that. Some people stay in the stock to be cash protected.
All right, we go to segment 3. We'll look at the returns for founders versus shareholders as soon as we get back.
Okay.
And we're back with Bill Houlihan. He acts as a CFO and board member for SPACs, the hottest trend on Wall Street right now. Let me just finish up on warrants before. Are they essentially trade like options? What market are they on?
Yes, no, they're the warrants trade on whatever exchange that the SPAC is listed on. They're most commonly traded on NASDAQ because.
Okay, so they don't trade on the Chicago Board of Options or anything.
No. And the interest that one other thing that as the market has evolved, Jim, is not every deal has the same warrant coverage. It was common for a first-time SPAC sponsor, the Thunderbridge, when we did it, to offer to investors a unit that was 1 share of stock plus 1 warrant. As the market has evolved, and sometimes they're like Thunderbridge has now done a second deal and a third deal, where there are some very well-known investors, Bill Ackman and others, coming to market. Not every deal gets 1 share plus 1 warrant. Sometimes the structure, if the sponsor has the credibility, can be 1 share and say half a warrant, or 1 share plus a quarter of a warrant, because the sponsor has extra credibility and doesn't
get away with it.
And doesn't have to give quite as much incentive to people to invest into the SPAC. Again, it's not a terrible thing. You can make an intellectual argument that fewer warrants outstanding,
less dilution,
less total shares once a deal is done, so that indirectly may be better for the common shareholder.
Okay, let's talk about this now. There's been questions: are SPACs great for founders and not as great for shareholders? Obviously, your deal was awesome for that, but the question, I guess, surrounds what they call first of all, the 25% in total, I guess, that the founders end up getting. Right? There's a 20% equity share, and then there's 5% called the promote, which is for risk capital. And obviously, you would wonder 25% is a rather big chunk of the deal. Talk about that.
Sure. Yeah. Well, if you go back to one of our prior comments, is the 100% of the proceeds from the SPAC IPO is put in trust for the common shareholders. That's good for the common shareholders, protects their interest. How does the sponsor make money then? The sponsor, unlike in a closed-end fund or a REIT or whatever, can't pay itself out of the IPO proceeds. So the sponsor has to raise private equity to fund the deal. In return for that private equity, the sponsor gets pre-IPO shares, if you will, in the SPAC. The market convention is that the sponsor gets 20% of the pro forma shares being issued, reserved for the sponsor. That's not free equity, if you will, because the sponsor, when it raises its 3% of the IPO proceeds, can't just keep all that money for itself. It has to sell effectively some of that pre-IPO equity to other investors to get them to invest in the sponsor. So, and that money is not pari passu with the common shareholders. It's subordinated to the common shareholders. So if the SPAC sponsor can't get an IPO done, those pre-IPO shares are worthless. If the SPAC sponsor gets an IPO done, but can't find an acquisition and has to dissolve itself, then those pre-IPO shares, again, are worthless. They are valuable if it gets an IPO done, if it gets an acquisition announced and closes, then those shares are valuable. And upon closing, they go from being subordinated to the common shareholders to pari passu with the common shareholders.
Is this like friends and family, the venture capital?
Friends and family, but it's also, it has become broader than that. A first-time sponsor, is usually friends and family. But our Thunderbridge 2 second deal, the third deal, or again, Bill Ackman or other people who were very, very well known in the marketplace, they have a lot of institutional money volunteering to be part of the sponsor. They know the money's at risk, but they also know that the investing pre-IPO at $2 a share or $4 a share or wherever the deal would be struck, can be very, very attractive if the deal works.
So you don't charge hedge fund management fees, basically, where you're getting a fee just for managing the money. but your money sits in the bank and you can't really do much about it. Now, Jim Simon's Renaissance Capital has researched this business, and at 313 SPACs are out there, only 93 have completed deals. And obviously, investors aren't making money on cash. Is this something with the maturity of the market, or how would you respond?
No, it's an excellent observation. Is will the deals work is for a large part of the market to be determined. And but one of the kind of the way the market has evolved with so many SPACs out there is many SPACs now are effectively making minority investments in large private companies rather than doing a true acquisition of a majority interest in a private company.
How does that impact it? Less control, or is that good or bad?
It's mixed.
Okay.
But it's kind of a nature, or maybe an expression of how the market has evolved. The early SPAC deals were usually acquisition vehicles trying to buy a company that was smaller than bigger than the VCs wanted to invest, smaller than corporate America or private equity was usually wanting to invest. As the SPAC market has grown and the deals have gotten bigger, many of the SPACs, rather than trying to buy a company, buy majority ownership of a company, are now promoting the idea of we'll own a minority stake in your company. So our SPAC 2, Thunderbridge SPAC 2 is an example of that. The company that we announced an acquisition with in December 2020 is called Indie Semiconductor. We determined in our negotiations that Indie had a market value of approximately $900 million. We contributed $345 million, which was the value of our SPAC, to Indie. As a result of that, the combined company will have a pro forma value of more than $1 billion, but the former Indie shareholders will have majority ownership. The SPAC shareholders will have minority ownership.
The SPAC will be around 30% ownership?
Yes. So you can structure any deal any way, but kind of the most of the deals getting done now are SPACs taking a minority ownership rather than a controlling ownership, but the combined company is then public. And the other thing that many private companies are finding, that this is an attractive way to get public compared to doing their own IPO. If they do their own IPO, they have to maybe commit to a year or so of a process with their lawyers, their accountants, with the SEC, then get to market and hope the deal goes well. So it's a lot of time frame to be at risk for. If you instead merge with a SPAC has already gone public. It's already spent the time and the effort with the lawyers and the SEC. Now, when you announce a transaction with a SPAC, it doesn't close right away, but it can potentially close in about 3 to 4 months, the period that it takes to put together a merger prospectus rather than an IPO.
Let me ask you, I'm a private company guy. I'm a tech entrepreneur. You guys buy me into a SPAC. How much independence do I still have? How much hands-on do you guys do, or do you just sit back?
Again, well, kind of as I said, in other parts of the market, of SPAC market, it's negotiable, but the most common structure is the private company management becomes the management of the combined company. SPAC will have board representation in the combined company based on its ownership in it. So in the transaction I mentioned before for Thunderbridge 2, Indie Semiconductor, where the SPAC is going to have about a third of the ownership, pro forma ownership of the company, we are going to have 1/3 of the directors. We'll nominate 1/3 of the directors. The company we're merging with will nominate 2/3 of the directors.
Do all these get for the SPAC, for the sponsors? The goal is to unwind this, and then the tech guy is basically a standalone publicly traded company.
Yes,
or you might hold them. You might hold them. VC firms get held for 7 years, right?
Yes, but well, the goal for most SPACs, including the Thunderbridge SPACs that I've been involved in, is to do another SPAC, to do a successful SPAC transaction, get credibility, which gives you the wherewithal to do a new SPAC. And if you do a new SPAC, then you can get a chance to get an additional round of founder shares in the new company and start the process again.
So the former SPAC you're hoping to have spun out, and then your hope to go in the direction of a new SPAC for the sponsors. Is that right? Or?
Yes. So it's very similar to the private equity business or the hedge fund business or any asset management business. You want to grow your AUM. What SPACs do, though, is because each deal is a discrete deal, you can't grow your AUM inside the SPAC. You have to do a new vehicle for each new potential acquisition.
All right, our final segment coming right up.
Just breathe.
We're back with Bill Houlihan, involved in running SPAC, special purpose acquisition companies, and finishing up on Jim Simon, who's an interesting guy, by the way, because I came across him. He invested in Madoff, and how they figured out that something didn't smell good. But, he's basically raised this issue of whether this is a great deal for shareholders or a better deal for founders. We've just talked about the ROI is obviously hurt if most of the SPACs are sitting on their cash. How would you sort of summarize those issues? And in the end, obviously, the industry's got to have good performance, right, for individual shareholders as well.
Of course, no investment will last more than a short period of time if it isn't a good deal over time for most parties. So the SPAC market now, you can bifurcate it into closed deals and pending deals. There are deals that have been closed in recent years, and many of those have traded well. Now that is a function, if you notwithstand, even with the COVID disruption in the market last year, that's a function of the underlying market. Stocks are up overall. Tech stocks are up more than the usual stock. Most SPACs have done business combinations with companies that are tech oriented. So the deals that have closed are in where the market has been trending favorably.
How have you found companies, and how have you raised the capital?
Okay, it's kind of very interesting. When we did our first SPAC in 2018, we thought we'd have to allocate a lot of time for looking for targets. That's not the case at all. It turns out that every potential seller in the world and investment banking, legal, and other advisors to sellers know who the SPACs are. They track the public markets. They know who's raised money, and they know SPACs.
So they're coming to you.
Unlike corporate America. Corporate America does acquisitions, but doesn't have to. PE firms, VC firms are always looking for deals, but also can sit on the money. A SPAC has to put the money to work within 2 years or it goes out of business. And if you're a SPAC raised money a year ago, you got to do a deal within a year or you're going out of business. So the sellers and their advisors know where to look. The hard work for a SPAC sponsor is figuring out what is really an actionable opportunity or is not going to be a good use of time.
How do you have the discipline you're coming up on that clock where you got to spend the money or you got to give it back? You don't want to give the money back. Is that a little risk that you're going to do a bad deal just to make sure the money gets used?
It absolutely is a risk to all sponsors. And where I see kind of the market has evolved recently, it's a little early to say there are bad deals being done because there's a lot of deals. Some deals have closed, more deals have been announced but haven't closed yet. But I'd say on the margin, the SPAC managers are willing to take more of a bet on a business plan and a set of projections than VC firms and private equity firms. That's certainly been a trend. So,
what does that mean? More risk or less? What does that mean exactly?
Well, certainly, all things being equal, yes, more risk.
Yeah,
there is a business plan, and
They're always good.
Right. Nobody doesn't have a hockey stick. Nobody says my plan is going to be 8% growth count like paid off. It's going to be guaranteed. Don't worry. No, everybody has it's going to be a slow build and then a huge takeoff. But I'd say a typical VC firm, if they like that plan, they'll say, I like it, but I'll give you 10 million, I'll give you 30 million for it. Or a PE firm would say, I like it, I've got more money to invest, but I'll give you 100 million. And in return for that, I want a lot of ownership, I want a lot of control. The SPAC, because it has to spend 100% of its money, it got to put it out. It is more willing to bet on the business plan and say, I love what you're doing. I know it could be wrong, but if it works, it'll be terrific for all of us. So let's instead of look at your 2-year revenue, 2-year earnings projections, we'll look at your 5-year projections. We'll discount them back, but we'll take that bet on that 5-year plan, because if it works, it's great for us and for you. What you are getting, private company owner, is a whole lot more cash than you'd otherwise get, and a whole lot more freedom than you'd otherwise get in any other structure. And
a higher multiple too, right? Because it's like a quasi-public.
Yes, well, there's now there's more people looking at deals, so on the margin, valuations have gone up.
Now, what you've just said implies that it's key the sponsors know what the heck they're doing. Because when you're betting on a business plan, it's obviously coming from some of your past history of understanding, say, the fintech business or whatever.
Unquestionably, you have to have understanding of M&A markets. You have to understand valuation, and you also have to have discipline, because as much as you want to put the money out, and maybe you'll take some business risks. This might work, it might not. Okay, I'll bet it might work. You don't want to do a bad deal, because if you do a bad deal,
you're not getting any more money.
Yeah, you're not going to do a second SPAC or a fourth SPAC or whatever.
Yeah.
So that is the incorrect discipline in the market.
Where do you see SPACs going?
I think they're going to continue to be a very, very big, vibrant market. What has evolved here is that it is not just for small size transactions that didn't kind of what the market was before. It is now an viable alternative to going public by yourself, or doing a large private equity raise through major private equity firms. And it is an apples and oranges execution. Yeah. Not every private company wants as much money as they can get from a SPAC. Not every private company wants to be public and have the public visibility.
How many do you guys see doing a significant number of deals?
Well, we're taking it one at a time. I mean, we are very, very conscious that we're in the asset management business. You'd like effectively to get the AUM and do another vehicle. But we're also very, very conscious of if you're an asset manager, you can have a down year.
All right, it's been
a bad deal. You're out of business.
You're out of business. Yeah, this is been a great interview, because you've been very candid of the up and the downs and the risks. You guys have been very successful so far, but obviously the proof in the pudding is when the market gets tougher, as it is. I want to thank Bill Houlihan. This has been Business Talk with Jim Campbell. Go to our YouTube channel, jimcampbellradio.com, and you can pre-order our upcoming book, Madoff Talks, Uncovering the Untold Story Behind the Most Notorious Ponzi Scheme in History. It's coming out from McGraw-Hill on April 27th. It's up right now on Amazon. Thanks to Bill Houlihan. Thanks to our national audience for listening. We'll see everybody on the next edition of Business Talk with Jim Campbell.